regular readers and viewers know in the last few weeks that I've been uneasy. A month ago I was downright panicky, grumpy, and a week or two ago, old cowboy line about it's too quiet out there. This week it broke. There are times when you can see tension building in a marketplace. The conditions precedent to event, especially in financial markets. There's an old Wall Street line for everything, and one of the best ones is markets can stay irrational longer than you could stay liquid. You've entered a trade in an expectation of an event because you can see the conditions, but you run out of money to maintain the trade before the event happens. And the break this week was just as clean as it could be. The Europe story has bored everybody to death for a half a dozen years, but the prior European stories have been financial market events. Runs on banks, runs on Greece, runs on European bonds, all of which could be stopped by the European Central Bank, largely just saying so, defying traders to trade against it. Don't want to trade against the central bank. It has an infinite amount of liquidity. But what finally cracked this week is the European economy itself, which has been the worry all along underneath the market operations. And the crack now includes Germany, which may get the Germans' attention, but will, in my view, almost certainly not be enough to deal with the underlying problem, which is the euro itself. But the thing to watch here, ignore everything else, ignore ISIS, Ukraine, ignore U.S. economic data, and ignore all the domestic chatter, is going to be in the next week or two, Germany's going to have to decide whether it's going to let the European Central Bank adopt quantitative easing Fed style, or Germany may decide that there'll be some relaxation in its demands for austerity on the others, or Germany may decide to spend some of its own money. My deep hunch, and markets can stay irrational longer than I could stay liquid, but my deep hunch is that whatever the Europeans do, will just buy time. The less they react, the more pressure behind the currency moves that have been underway. The currency moves, the dollar strengthening, the euro and the yen and other currencies weakening, that force is what's pushing U.S. interest rates down. It's got mortgage rates almost down to 4%. If you got a big down payment and good credit, no points. The currency pressure is so great that it's putting the Fed on hold, which in a totally circular fashion suspends the currency movement. Some of the currency movement is anticipation that the Fed goes up while all the rest of the world central banks go down, but the pressures are intractable. But for news, just keep an ear on Europe and what it does. If Europe announces rescue measures, the world's going to tend to believe it, and the interest rates will not continue the decline that they've been in. The less the Europeans do, the weaker the European economy gets, and God forbid spreads to the U.S. economy, then the more legs this interest rate run has to take. In the charts next to this video, you will see in a 2-year chart of the 10-year Treasury note that we are this far away from a market move which a year ago has no chart support. And we could drop suddenly well below 4, all of a sudden, as impossible as it sounds. Thank you all. Good weekend.